Money, it's how we buy our daily bread, afford a pint at the pub, and even measure our self-worth, though we really shouldn't. But have you ever stopped to think about where money comes from? It doesn't just magically appear in our bank accounts, does it? Well, get ready for a wild ride, because the truth about money creation is more bizarre than you might think. We're about to dive deep into the fascinating world of finance, exploring how money is created, how it flows through the economy, and how it can sometimes spiral out of control. Buckle up, because this is one roller coaster you won't want to miss. Think of money as the lifeblood of our economy. It's the fuel that keeps businesses running, people employed, and goods and services flowing. But just like blood, too much or too little of it can cause serious problems. So, understanding how money works is crucial for anyone who wants to make sense of the world around them. By the end of this journey, you'll have a newfound appreciation for the intricate workings of the financial system and the power of that little piece of paper, or more likely the numbers on your screen, we call money. Let's get started, shall we? To understand how money is created today, we need to travel back in time. No, not to the dinosaurs, but to a time when goldsmiths played a surprising role in the birth of modern banking. Imagine a time when people kept their gold safe with these goldsmiths, who had secure vaults. Each time a goldsmith received a deposit, they issued a receipt, a simple IOU. People began using these receipts as a form of payment, trading them instead of lugging around heavy gold, and thus the first paper money was born. These receipts represented a claim on real gold, making transactions smoother and more efficient. But here's where things get interesting. Goldsmiths, being savvy businessmen, noticed that people rarely withdrew all their gold at once. They realized they could lend out a portion of the deposited gold and charge interest on it, creating more profit for themselves. This seemingly harmless practice was the spark that ignited the engine of modern banking. By lending out deposits, goldsmiths were essentially creating new money, and so the concept of fractional reserve banking was born. Fast forward to today, and the principles remain remarkably similar, albeit with a digital twist. When you deposit money into a bank, you're essentially giving them a loan. The bank doesn't stuff it in a vault anymore. Instead, it keeps a fraction of your deposit as reserves, thanks to those fractional reserve banking rules, and lends out the rest. Now here's the kicker. When the bank makes that loan, it doesn't just hand over your money, it creates a new deposit account for the borrower, increasing the total amount of money in circulation. Let's say you deposit £1,000. The bank might hold on to £100 as reserves and lend out £900 to someone else. That someone else now has £900 in their account, even though your £1,000 is still sitting there, well, most of it. Like magic, new money has been conjured. This process of lending, creating new deposits, and further lending amplifies the money creation effect. It's how banks, through the magic of fractional reserve banking, literally create money out of thin air, or at least the digital equivalent of thin air. Section 4. The velocity of money, a game of hot potato with your wallet. Now that we understand how money is created, let's explore how it moves within the economy. This is where the concept of velocity of money comes into play. Think of it as a giant game of hot potato, with money being the potato. The faster the potato gets passed around, the more transactions occur. In economic terms, a higher velocity of money means more spending, which generally leads to increased economic activity and potentially even economic growth. Imagine a simple economy with just 4 people: a farmer, a baker, a tailor, and a shoemaker. The farmer sells wheat to the baker for £10. The baker uses that money to buy a hat from the tailor. The tailor then uses that same £10 to buy shoes from the shoemaker. In this scenario, the same £10 has circulated 3 times, facilitating 3 separate transactions. The faster the money changes hands, the more goods and services can be produced and consumed, even with a fixed amount of money in the system. Section 5. Inflation, when too much money chases too few goods. But wait, there's a catch. Remember that money creation magic we talked about? Well, like any magic trick, it comes with its own set of potential problems. One of the biggest is inflation. Imagine our hot potato game again. This time, instead of 1 potato, someone throws in a whole sack of potatoes. Suddenly, everyone has more potatoes than they can handle. What happens? the value of each potato plummets. The same principle applies to money. When the money supply increases faster than the production of goods and services, we get inflation. Too much money chasing too few goods leads to a general rise in prices. Remember that £10 loaf of bread? It might suddenly cost £12 or even £15 if inflation runs wild. Inflation erodes the purchasing power of money, making it harder for people to afford the things they need. It's a delicate balancing act. A little inflation can be a sign of a healthy economy, but too much can be detrimental. Central banks around the world constantly monitor and adjust interest rates to try to keep inflation in check. As Section 6, the governments roll bonds, spending and their impact on your wallet. Now, let's talk about the government's role in all of this. Governments need money to fund public services like healthcare, education and infrastructure. One way they raise money is by issuing bonds. Think of government bonds as IOUs issued to individuals and institutions in exchange for a promise of repayment with interest. When people buy these bonds, they are essentially lending money to the government. This influx of money from bond sales can be used for government spending, which injects more money into the economy. While this spending can be beneficial for growth, it can also contribute to inflation if not managed carefully. It's a delicate balancing act, much like walking a tightrope while juggling chainsaws. Section 7, conclusion. Money makes the world go round, but understanding it is key. So there you have it, the fascinating, sometimes perplexing world of money. We've journeyed from the goldsmith's workshops to the digital age, uncovering the secrets of money creation, the velocity of money, and the ever-looming threat of inflation. We've seen how banks, through the magic of fractional reserve banking, create new money by lending out a portion of your deposits. We've learned how the speed at which money changes hands, its velocity, can impact economic activity. And we've explored the delicate balance between money supply, goods production, and the potential pitfalls of inflation. Understanding these concepts is crucial for anyone who wants to navigate the complexities of the modern economy. After all, money might not buy happiness, but it certainly plays a pivotal role in shaping the world we live in. So the next time you use your debit card or glance at your bank balance, remember the intricate web of financial transactions happening behind the scenes. It's a system that can be both awe-inspiring and terrifying, but one thing's for sure, it pays to understand how it works.